Thank you, Carol. Please confirm you can hear me. Thank you. Good afternoon, everyone. My name is James Juma. I'm in the pension division. I'll take you through a brief understanding of taxation of pension schemes. Just to mention that the pension industry is a very unique industry in terms of how it is administered, in terms of how reporting is done. It is very unique. So, and it affects most of us. We belong somewhere in the pension cycle, either through the statutory deductions on NSSF, or you are in the public sector. Judy is saying she can't hear me well. Carol, please confirm if my audio is clear enough. Okay, thank you. Okay. Yeah, thank you. Just you can also shoot your if my audio is failing, as Judy has said, just shoot. I'll be able to check my connection. So in terms of the order of play, we will look at legal and regulatory framework. Basically, in terms of regulation, how is the pension industry regulated? We'll also look at the classification of retirement benefit schemes. And then very critical, we will look at registration, both with the regulators, that's RBA, and also with KRA. We'll look at the obligations for pension schemes and also incentives available to members saving with various retirement schemes. And then we'll also give one or two recommendations on what you need to do if your scheme is not compliant in any of the perspectives that we'll be looking at. So in terms of the legal and regulatory framework, generally the pension industry is regulated by RBA. That is our regulator. Florence is saying can't hear anything. Caro, can you hear me? Okay. So maybe Florence, you need to check your connection. So I was saying in terms of regulation, we are generally regulated by the Retirement Benefits Act of 1997. We have also public sector schemes regulated by the Public Service Superannuation Act of 2012. This just came in the other day when most of the defined benefit schemes are converted to defined contribution. We also have the statutory scheme, that is NSSF, regulated by the NSSF Act of 2013, whose implementation has come into effect in this financial year. In terms of the tax bit, the schemes are regulated by the Income Tax Act and also Tax Procedures Act in terms of compliance and penalties, if any. So basically, when you look at those regulations, they'll give you an end-to-end perspective of how you need to register. It means if you're an employer, you want to establish a scheme for the benefit of your employees, then it means you need to start at RBA so that you're able to go through the regulations in terms of what you need for registration. If you are in the public sector, this is from ministries, state agencies, those will fall under the PSS. All of us, I'm sure, we are currently receiving deductions for NSSF. So it means we, as a country, we are covered in terms of anyone in the employment sector. It means you are somehow receiving getting deductions on your payslip for NSSF. So we will basically give, as we go through the presentation, put these regulations at the back of your mind. They'll give us a guideline in terms of how the industry is regulated. So generally, schemes are classified as follows. We have a defined contribution and defined benefit schemes. So the difference between a defined contribution and defined benefit scheme is that for defined contribution scheme, you as an employee contribute to the scheme with your employer contributing either a percentage or an amount towards that scheme. While for defined benefit scheme, as was the case of most civil service schemes, for teachers, doctors, all of them, they were defined benefits, meaning the benefits is determined at the beginning, and then based on how many years you will be in service and the last salary that you will be paid, then a benefit is computed by actuaries. We also have provident funds and pension funds. This is the difference in terms of how members access their funds. For provident funds, you will access your funds as a lump sum, while for pension funds, you will access a third of your total accumulated benefit as a cash lump sum, while the 2/3 can only be used to purchase an annuity or an income drawdown with an insurance company. We also have occupational schemes versus individual schemes. So an occupational scheme is any scheme that is tied to an occupation. You are a teacher, you are an accountant, you are working somewhere. Then it means if your employer has set up a scheme, a standalone scheme, then that would be identified as an occupational scheme. An individual scheme is one whereby administrators will set up a scheme and invite individuals. So let's say your employer does not have a pension scheme and you say you want to contribute towards pension, then you will look in the market, check on the RBA website for individual schemes that are registered by the regulator and contribute towards an individual scheme. For umbrella schemes, assuming you are an employer, you have 5 to 10 employees, you do not want to set up a standalone scheme for the benefit of your employees since they are few, and you are being sensitive to the cost of administration, you will join an existing umbrella scheme. So an umbrella scheme will put together many different participating employers, and they will sign a document called a deed of adherence to basically adhere to the trust and rules that has been set by the umbrella scheme. And then finally, we have the statutory scheme. This is NSSF. This is mandatory for anyone in the workforce to be able to contribute as per the NSSF Act of 2013. Very important, I will take you through the process of registration with the regulators. I have been in this market for some time, and I've seen administrators having a challenge in terms of how they're able to manage the registration process. So remember, as I said, where to start is you go to RBA, say you want to establish a scheme. I have been in the market for able to select the registration scheme for the benefit of your employees. So you'll go to RBA and provide them with all the requisite documentation. So these are trust deed and rules. Provide them with all the requisite documentation. So these are trust deed and rules. A list of trustees. These will be like the legal owners of the scheme, and also provide them with documentation in terms of minutes that you've sat together and decided to establish a scheme for the benefit of your employees. Then RBA will look at those documents, and after they've done doing the evaluation, they will issue with an RBA registration certificate that is unique to your scheme. Once you receive that RBA registration certificate, you are now supposed to proceed and come to KRA, provide your RBA registration certificate, also provide the trust deed and rules of the scheme, and we will now use those documents to be able to provide you with a KRA PIN. So you'll apply on iTax the way you will normally do if you want to register for a new PIN, and say this is an individual, and quote the RBA registration certificate number as the unique identifier for KRA to be able to issue you with a KRA PIN. So once you have been issued with the KRA PIN, this is where most pension schemes stop. Once they have a KRA PIN, they think that is enough, and you will get into trouble with the law. You are supposed to go further and apply for exemption on iTax, indicating the correct paragraph under the first schedule of the Income Tax Act, that, for example, this is a registered pension scheme, or is a provident fund, or is an income drawdown fund, or is an annuity fund. So you'll have to specify that as per the first schedule of the Income Tax Act. So you can go on iTax registration, other registration, then apply for tax relief scheme. You'll attach your tax deed and rules, the RBA certificate, and the checklist to confirm under which paragraph you intend to be registered for exemption. So this is a very important step. We have had cases where a scheme, for example, a founder or an employee, for example, has set up a founder or an employer has set up a pension scheme for the benefit of the employees. However, they did not register or apply for exemption, but they went ahead and gave their employees the benefit in terms of the relief on contributions towards the pension scheme without having a tax exemption certificate. You'll have a challenge because when you invest the funds of the scheme, all the providers in the market in terms of the fund managers, the people investing the funds of the scheme, and the custodians, and even central bank will be withholding tax on the investments of the scheme because you do not have an exemption certificate. Carol, please check. I'm still getting messages that my audio is not, that they can't hear anything. Confirm you can still hear me. Okay. So if your scheme has been issued with the old exemption certificate, remember there are schemes that were registered prior to iTax, that is prior to 2015, and during that time the KRA was issuing paper exemption certificates, the old exemption certificates, or sometimes you are issued with a letter in lieu of the exemption certificate. You need to update that data on iTax. So you still go to iTax on registration, apply for tax relief scheme, but specify that you already have an exemption letter or you are already issued with the old exemption certificate so that KRA is able to update the record on the database and issue you with the new exemption certificate. Remember, currently CBK is rejecting some of those old exemption certificates and even letters saying that they are not legal documents. So it means you need to update your position if you have an existing pension scheme. And if you are applying as a new pension scheme, then you need to include this process as part of your normal compliance documentation. So once you have been issued with a tax exemption certificate, you are supposed to present that to anywhere you are investing, anywhere the scheme is investing. So to the fund managers, to the custodian, if the scheme has property to your tenants, to confirm to them that you are that the scheme income is exempt from withholding tax. So remember, the tax exemption certificate is meant to exempt the scheme's investment income, that is interest, dividend, and rent, from being charged withholding tax at source. So in the absence of this tax exemption certificate, it means if you are receiving interest or dividends from interest from treasury bonds, for instance, or dividends from listed equity counters at NSE, they will charge you withholding tax at the prevailing market rate. In terms of obligations and incentives, just to mention that we have also had scenarios in the industry where members of the schemes imagine that the pension contributions, since they have an exemption certificate, they are not supposed to pay any form of tax. So this is just to confirm that we operate an exempt tax regime on administration of retirement benefits. So meaning at the point of contribution, if you are contributing to any registered pension scheme, when you check your payslip, assuming your contribution is 20,000 towards a registered pension scheme, it means it will be reduced in computing your monthly taxable income. So if your monthly gross salary is 20,000 and you're making a contribution of 20,000, payee will only be will computed on the net of 100 minus 20. So the point here is that as much as possible, you try to maximize on the relief of 20,000 per member per month. So the other scenario is assuming I am contributing 30,000 Kenyan shillings. How is the relief computed on pay as you earn? It means on the first 20,000, I'll be able to get a relief, so that will not form part of my taxable income. But any amount in excess of the 20,000 will go to what is called the non-exempt contribution, and will be charged pay as you earn at the prevailing graduated scale. So the contributions not charged to pay as you earn at source are classified as exempt or registered, while the amount that is in excess is classified as non-exempt or unregistered. So this is just for purposes of differentiating in terms of the tax being charged at source. Remember, the tax on pension benefits is a deferred tax. So the government is giving you a relief of 20,000 per month, so that to incentivize you to plan for your retirement. Remember, you'll not be in employment for 100 years. At some point, you will retire. So the incentive is meant to make you accumulate as much as possible towards your pension pot. How is investment income that is accrued on the contributions that you make on a monthly basis treated for tax purposes? So as I've mentioned in the previous slide, contributions up to 20,000 per month are exempt from taxation at the point of contribution, and the income that is accrued on those benefits is also exempt from taxation. So your 20,000 has accrued some interest of 5,000 for the year. It means when you look at your annual statement, on the registered or on the exempt portion, you should see 20,000 as the principal contribution and 5,000 as accrued interest. Any amount in excess of 20,000, the contribution is not taxed since it has already been taxed at source. However, the income that is accrued on the non-exempt contribution is charged corporation tax at the prevailing rate of 30%. So let's say you have 100 employees, you have a fund that is 100 million in size. Out of that 100 million, 80 million is registered or is exempt, and 20 million is non-exempt. At the end of the year, if you have accrued interest on the total fund of the scheme, the portion that is the 20% that is non-exempt, the income on it will be charged tax at the prevailing rate of 30%. So what happens when there is separation from the employer, either through death, retirement, immigration? The accumulated fund credit, that is contribution plus interest arising out of the exempt portion, will be subject to withholding tax on a graduated scale, depending on the age of the member. So we have also had a very prevailing challenge where members of pension schemes complain either to the regulator or to their employers that they have been charged tax on their pension benefits, yet they were not aware of the implication in terms of tax. So this is just a confirmation that, remember, as I mentioned in the previous slide, that the 20,000 incentive is for you to be able to accumulate as much as possible in your active working years. However, there is a deferred tax on that amount that will be paid at the point of exit. And the withholding tax that will be charged at the point of exit when you separate with the employer is a final tax. So we have given just an illustration in terms of how your benefits are taxed, depending on the age that you are accessing your benefits. Just to mention that effective, I think, last financial year, the regulation on access of benefits was changed from accessing 100% of your own accumulated benefit plus 50% of the employer to currently you can only access 50% of the total fund credit. So if your statement reads 5 million, it means you will access 2.5 million, while the other 2.5 million will be deferred up to the minimum age of retirement, which is 50 years. So this is just an illustration in terms of the treatment of your accumulated benefit when you access your funds after the age of 50 years. You will receive a preferential tax treatment. When you look at these amounts, you see over and above the tax-free amount of 60,000 per year times the number of active years of service, or capped to a maximum of 600,000, your benefits will also be taxed on expanded tax bands. So if you have a benefit of, let's say, 3 million, it means the first 600,000 you'll get a relief, and then the next 400,000 will be taxed at 10%. The next 400,000 at 15%, and then any amount in excess of 1.6 million will be taxed at 30%. We'll compare that with a member that chooses to access their benefit before the age of 50 years. So they will get a bigger hit in terms of the tax, the withholding tax they will pay on the accumulated benefits, because their benefits will be charged on annualized payee rates. So meaning more of your money is being taxed at the higher band of 30%. So in the previous slide, we have seen 600 plus around 300-400, that's about 1.8 million, is being taxed at lower rates, that is 10, 15, and 20%. While if you choose to access your benefits before the age of 50 years, more of your benefits will be taxed at the rate of 30%. So you can, as you can see on this slide, income, any monies above 388,000 is suffering tax at the highest band. So we've given an illustration in terms of how the benefits look for a member that chooses to access their benefit below the age of 50 years, while another chooses to access their benefit above the age of 50 years. The illustration has used an amount of 5 million. So we are assuming that both of them have been in the service of the employers for more than 10 years, or they have already exceeded the 10-year limit. So they are earning the relief of 60,000 per annum for 10 years. So that's why we have that relief of 600,000. So for the subsequent amounts, the member that has accessed their benefits at age 50 or after age 50 is going to be taxed on the graduated scale that has expanded bands of 400,000. So they will pay tax of 1,070,000 for that period, while the member that has accessed their benefits below the age of 50 will pay tax of 1.2 million, so meaning they will access a lesser benefit by 187,400. Just to mention that Treasury is in the medium-term revenue strategy that is in draft now. They are proposing to, as part of their changes, revise some of these regulation in terms of treatment of pension benefits. So you might see a few changes in terms of when tax will be charged on pension benefits. I urge you to go through the midterm revenue strategy paper so that you're able to understand what will be the impact on your benefit as we even as we wait for public participation on that strategy paper to proceed. In terms of conclusion and recommendations, this is the most important of the process. We receive a lot of calls in terms of people asking they do not have our scheme has not had a tax exemption certificate for the last 10 years. We have been giving members relief. So what happens? Will KRA charges penalties and interest? Or you will see another scheme that in their financials, they are carrying a lot of money in terms of tax recoverable just because they have been charged withholding tax on the investment income. So if you are carrying withholding tax, you are carrying tax recoverable in terms of withholding tax credits, and yet you do not have a tax exemption certificate, then I'm sorry to inform you that KRA is not going to recognize that that recoverable, and you will not be able to use it anywhere, because then the only document that binds the authority in terms of exemption is if you have a valid tax exemption certificate that you can be able to issue to any of the service providers that you have transactions with. So just to mention that a tax exemption certificate is for purposes of exemption from withholding tax on investment income. So this does not mean that as a pension scheme or as a member of a pension scheme, you will not pay tax on the contributions, on the entire contributions that that you make. But as long as even members of NSSF, with the little contributions that people contribute towards NSSF, all that on a monthly basis go towards what we call registered or exempt contribution. At the point of exit, your NSSF contribution will be charged tax at the prevailing on the graduated scale, depending on the age that you will access your benefits. Either the members that access on death, so they will have their beneficiary accessing below the age of 50 years. But in the ordinary business, members access their NSSF contributions after the age of 50 years. So you will still incur taxation on the amount that was not taxed at source. Remember, as I mentioned, this is a deferred tax. So at the point of exit, the assumption is that you've accumulated enough money to be able to take care of your retirement needs. So a portion of that will be charged to taxation. Just to mention that above the age of 65 years, you are able to access your pension benefits without tax on the monthly pension. However, the lump sum that you will access, you will be charged a tax on the expanded tax brackets that I've mentioned. So the tax exemption certificate does not absolve the scheme from paying corporation tax on income earned from contributions above 20,000. I would like to emphasize this. We have had pension schemes that have not paid tax for several years, particularly those that are being like public sector schemes being administered by their founders. You'll say that they will say we have had a tax exemption, so we are not supposed to pay tax. That is not correct. The correct position is that on income above the exempt amount of 20,000 on an annual basis, you are supposed to assess and pay corporation tax. So you will pay this in terms of total installment taxes, and then at the end of the year, once you've done your financials, you'll be able to pay any balance of tax. So just to mention that in terms of benefits where we have relief, pension has one of the highest. If you compare mortgage, if you compare income, if you compare contributions to post-retirement medical fund, if you compare all those other insurance products, all the other reliefs that we have, pension has the highest amount of relief because the government recognizes old age poverty is one of the biggest challenges that we have as a country. So they have given you that opportunity as a member to be able to ensure that you have a preferable income replacement ratio at the point of retirement. So industry experts project that if you are earning 100,000 shillings today, at the point of retirement, you should be able to replace your income by at least 70%. So if your last salary before retirement was 100,000, then you'll be able to live comfortably only if your income replacement ratio is at least 70% of what you are earning. So the challenge is for you to ensure, even as you maximize on the relief of 20,000 that the government has provided, you are able to also monitor your pension pot to ensure that you are at least above 50% and target the 70% income replacement ratio. So apply for exemption on iTax, even if you already have the old exemption certificate. So this is just for purposes of compliance. iTax is issuing, KRA is issuing those digital tax exemption certificates. Those you should be able to issue to CBK and any other provider that you invest with, including even the offshore accounts. Then finally, for taxation purposes, death in service benefits are treated the same way as normal benefits. This has also been very contentious and very emotional. We receive a lot of feedback in terms of a principal member has passed on, their beneficiaries come to your scheme to claim benefits. They will give you those warrior scenarios that you are charging their benefits, and yet the principal member has died. So this is just a confirmation that for purposes of taxation, the death in service benefits are treated the same way as the benefits will access on normal retirement. So thank you very much. I would like to stop there. This is just a brief highlight in terms of how the industry is administered from a tax perspective. I would like to stop there and go through the chat to be able to respond to some of the questions. Caro, I'll take it back to you. Asanteni sana.
Yeah, you've unmuted me. Thank you. I'm not the presenter. Okay, so let me share my presentation. Can you see my presentation at your end? Okay. Okay, all right. So my name is Caroline Gitegi. I'm from Intelligence, Strategic Operations, Investigations, and Enforcement Department. And I want to welcome our very able taxpayers, our very able stakeholders to this session, whereby we're going to learn about the KRA Integrity Program. So in line with the KRA Integrity Program, our department's key mandate is to promote, to mainstream, to inculcate ethics and integrity in KRA, and also while working with our stakeholders. So allow me to comment with a quote. It said, "Integrity is the seed for achievement. It is the principle that never fails." So in our modus operandi as our stakeholders, as a taxpayer, we need to be well informed that integrity is very paramount in our processes, and we can't do without integrity. And whenever time we don't uphold integrity, we find ourselves maybe engaging in activities that are unethical. So we want to urge all of us to ensure that we promote integrity in our activities and also entrench it in our processes. And how are we going to do it? We are going to do it by always ensuring that we don't engage on matters corruption. And what is corruption? Because we may not really understand what really is, but some of us really know what it is. But basically, corruption is derived from a Latin word, corruptus, meaning to destroy. And this destruction symbolizes a breakdown in ethical and moral values. And we can attest that, or maybe we could come across people don't behave morally upright. Maybe we can say it's a breakdown of systems and institutions of governance. And that's why, as KRA, we are quite dedicated to keep you updated with our processes. Like for instance, now we are being taken through matters of pensions and other matters. but we want you to be informed about our systems and also our institution of governance, and also corruption symbolizes societal traditions and a personal value system, breakdown in societal traditions and personal value system. When there's breakdown and destruction of our systems, our ethical morals, of course, we will not be people of integrity. And corruption basically is both behavioral, there is attitudinal, and also systems problem. And for KRA, we want to address system problems. Why? Because we want people to be well informed with knowledge, because lack of knowledge, may people perish because of lack of knowledge. That's what the Bible says. So we need to be well updated with information, and that's why KRA is quite committed to that. Corruption also may occur in terms of inclination plus opportunity. When we have opportunity to do the wrong thing, of course, it may result corruption. When you're inclined to something, or probably there is pressure from outside, from inside, it may result to corruption. So there's need for us to ensure that we don't engage ourselves in various opportunities that may make us susceptible towards various unethical conducts. So our emphasis is let's just uphold ethics and integrity in what we do, and basically ethics refers to accepted norms and standards of conduct that establish guiding principles of one's public and private conduct. And this can be in form of us making the right choices, using conscience to make informed decisions, being honest, being fair, being responsible, and taking charge on what we do. We also want to emphasize that whenever time we conduct our processes, we operate our operations as taxpayers, as stakeholders, we need to uphold integrity. And basically, integrity, yes, yes. Mm. Now is that integrity? Let's see. Okay. All right. So to our stakeholders, we just urge all of us to work with integrity and succeed with integrity. And how can we inculcate that? It's by us developing code of conduct for our institutions, for us having service charter, and also systems of work procedures. We find that if there are no procedures, if there's no code of conduct, there's no way we can be able to do the right thing at the right time. In KRA, we have a code of conduct. We also have a service charter, which is uploaded on KRA's website. And this is meant to guide our taxpayers about our services, the timelines, to ensure that there's no opportunity that may result to matters of corruption. In our 8th corporate plan, ladies and gentlemen, there's a lot of emphasis on integrity, and that's why actually I've had to request for this session just to create awareness to us about integrity. There's need to improve our processes, and by us, we are doing it through enhancing integrity, institutionalizing KRA culture and value system, and also improving the performance management of our work. And this will lead to improved service delivery. Service delivery is very key. What has KRA done with regards to ensure that we are able to address corruption matters and to promote integrity? We have a fully fledged department, and our department, as I said, is called the Intelligence, Strategic Operations, Investigations, and Enforcement Department, which oversees integrity in KRA. And also, we conduct lifestyle audits for our staff. We do investigation for staff stakeholders, for people who don't adhere to integrity, and also for our staff who are found culpable. And again, also, we deal with matters to do with tax evasion. Also, what we've done to ensure that we've been able to promote integrity and also address corruption matters is automation. And I'm going to delve deeper on that. We've been able to automate various processes in KRA. For instance, we have iTax system, we have integrated customs management system, we have electronic cargo tracking system, we have a regional electronic cargo tracking system, the one-stop border post. I'm going to delve a little bit deeper on that. Also, we have the taxpayers charter that spells out the rights and obligations of taxpayers, which you can download it from our website. We have we normally train our stakeholders. Like now, this session is for training, just to ensure that we are well informed about our processes. Also, investigations of staff and tax evaders, and also enforcement of care record of conduct. Also, it's part of what we've been able to do. And also, we've been able to develop, been able to domicile, domesticate various policies such as a gift policy, conflict of interest policy, and also the whistleblower policy, which we are going to delve on it a little bit shortly. So on leveraging of technology, leveraging on a cutting technology is an area that I want to emphasize on, because some of us have been saying that KRA has not put in place various mechanisms and measures. There's still corruption, but indeed a lot has been done, and that's why there's need for us to be informed about what measures we've put in place to curb corruption. I talked about ITAX. I talked about integrated customs management system, and this is one of the system that some of us stakeholders or taxpayers we normally engage with whenever time we want to engage in matters trade. We work with clearing and forwarding agents. At times we come to KRA to seek for support, but I know some of us are well informed about the ICMS. eTeams, recently KRA was creating awareness about eTeams. Basically, this is just a software solution for sales and stock management. The solution provides transparency in invoicing, receipting, and stock management for taxpayers conducting commercial transactions. So it's meant to make our work to be simple, to be convenient, and also to be flexible. And I know some of us here have already begun using eTeams. Also, another initiative that KRA has done to prevent what we call dumping and also diversion of goods, especially for cargo meant for partner states. We've been able to develop a system called REX. REX is a web-based system, and REX in full is a regional electronic cargo tracking system. And this is a web-based system integrated with the customs management systems in the region. And the regions that actually these REX operates is Uganda Revenue Authority, Uganda, we have Rwanda, and now we have Kenya. So with regard to this system, it provides an end-to-end monitoring of transit cargo along the northern corridor. So how does it operate? This REX system is normally installed with a seal. So we normally have arming teams. So we normally arm a transit good with an e-seal. I know that you're able to see in my presentation. So we arm a transit good with an e-seal and attach the seal to the container and arm it. So in case there's any tampering by anybody, maybe if there are thugs who tamper that with that seal, we're able to get an alert. So we have our team from the Central Monitoring Center at Times Tower. They're able to monitor via the web-based system. And in case there's any dumping, in case there's any tampering, there's any diversion of that good, we're able to send an alert. And we normally have a team on the ground called RRUs, Rapid Response Units. They're able to respond very fast so that they get to know what is really happening to that cargo meant for the partner states. So this is just a photo demonstrating our officers, the way they're able to track the cargo via the REX system. And we normally have a 24/7 real time of alerts, and we take appropriate action. And also, we normally do what we call we're responsible for targeting and also risk profiling. So this is just a system that has been able to deter what we call dumping and also diversion of cargo meant for partner states. The next image is just demonstrates our REX. This is a rapid response unit, our officers. And I know you've come across those cars along the highway, written REX, border control. These are officers whom their work basically is to respond to any alert that is normally sent from our cargo monitoring central command center in case there's any diversion, because their work basically is supposed to be to keep track of the transit goods and also to ensure that there's no diversion and also dumping of goods. This is a system that has enhanced cargo security, and it has limited complaints and also enhanced accountability and also seamless movement of cargo within the EAC member countries. Besides that, also we are well informed about the one-stop and which necessitates to illicit trade, and I'm going to talk about it later on. But these are just some of the measures that KRA has put in place to enhance trade facilitation. Also, we have drive-through scanners, and from my presentation, you can see just a photo, an image of a drive-through scanner at the port of Mombasa, and this enhances transparency, accountability, verification of goods, especially when the transit pass through the scanner. Also, we have advanced cargo scanners that uses radiology, and these advanced cargo scanners are able to do what we call real-time. They take real-time images. We're able to know what that transit cargo has carried, and that image, when it's taken but by the scanner, it's normally shared with our team who do image analysis, just to get to know if that cargo has carried illicit items or uncustomed goods, prohibited goods, or even restricted goods. So we have advanced cargo scanners that uses radiology. Also, via the SDR, we have also, of course, a scanner, cargo scanner that's able to verify the goods. We also have handheld scanners. We have baggage scanners, and all these we are all aware about them, because even in your offices, maybe at your places of work, we are able to come across them. We have our four-legged officers. These are canines. We don't call them dogs, but they are four-legged officers, canines. And with this, we are able to do what we call we are able to verify dumping, diversion of goods, which enhances integrity. And also, we have what we call sealing of illegal routes. And we also have officers who do patrol at those illegal routes, for instance, maybe Moyale border. So these are just some of the initiatives that KRA has put in place to curb corruption, promote integrity. We have other strategies that KRA has deployed. For instance, technology is very key, blockchain technology. We do machine learning. We have enhanced project completion, artificial intelligence. We have a fully fledged department that deals with AI, artificial intelligence. We do data mining. We're institutionalizing KRA culture and value system, and also tax simplification. And that's why we're here, just to simplify our processes for you to get to understand what we really do. I talked about policies, and we've put in place various policies. For instance, we have the KRA anti-corruption policy, and KRA is zero tolerance towards corruption. We have a gift policy, and this gift policy, basically, we just want to urge our stakeholders, our taxpayers, not to be giving gifts to our staff, for instance, if they happen to support you or to assist you, because that is our duty. We are supposed to be selfless servants. But at times we find that taxpayers give gifts to KRA officers, maybe to expedite their processes, and this limits, or rather results to making improper decisions. And that's a way, that's corruption, basically. So we're just urging our staff, our stakeholders, not to be giving gifts to our staff. And in case those staff have been given gifts, they need to declare, because that gift is not theirs, it belongs to the state, it belongs to KRA. So we have a gift policy statement. Also, to our stakeholders, we have a whistleblower policy, and this whistleblower policy basically is meant to urge our public to provide information on corruption, on tax evasion, and any other malpractice without fear of reprisal, victimization, and discrimination. See, this whistleblower policy protects you from that. Also, we have the conflict of interest policy, and conflict of interest whereby your interest comes first, but not the interest of the institution. So, for instance, gifts may hinder, or rather may influence our officers. And we're urging staff, as I said, we're urging our stakeholders not to be giving gifts to our staff. Also, we're urging our staff and also our taxpayers to uphold the national values and the principles of governance. And Article 10.2 of the Constitution, we have 17 national values. And one of the national values is patriotism, whereby we need to pay taxes voluntarily. We need to uphold national unity. No, we need to uphold the rule of law. We need to uphold democracy and participation of people. As this session you are participating. Human dignity is also a national value. We need to also uphold inclusivity, human rights, non-discrimination, protection of the marginalized people, good governance, being accountable in the management of public resources, upholding integrity, being transparent, and also sustainable development is one of the national values that we have. So we have 17 values. I won't be able to delve deeper into them, but I've just mentioned. At your own time, you can focus on it. So last but not least, I'd mentioned about illicit trade. And basically, illicit trade is rather it may occur in the form of counterfeits, pirated goods, substandard goods, and custom goods, prohibited or restricted goods. And as traders, we find ourselves mostly purchasing these items which are prohibited or maybe not paying taxes. The forms of illicit trade might be smuggling, maybe dumping, or I talked about diversion of goods, illicit cash flow, trade in small and light weapons, unless maybe you have a license for that, counterfeiting or piracy or of illicit manufacturing of goods, so just forms of illicit trade. And probably the enablers for illicit trade is our porous borders. And with regard to these porous borders, of course, KRA has put measures in place to ensure that we do patrol at the borders together with the enforcement officers. But at the same time, also, we need to mitigate uh, engaging in illicit trade, regardless of also having proliferation of conflicts along the borders, which also could be a factor leading to illicit trade. So what are these examples of illicit trade? Illicit goods, for instance, is stakeholders or people engaging or rather faking our stamps. We normally have so many stamps, KRA excise stamps, which are fake. People are not trading with legit stamps, leading to corruption. So it denotes that we don't collect enough revenue, and especially for those who are dealing with beverages or other items. So what do? We normally intercept goods or items whenever time we find them to be illicit. So we normally intercept them. We prosecute the ones who have been engaged. Also, we destroy those goods with a multi-agency team. So the areas of focus for combating illicit trade probably are all border counties, airports, and also the northern corridor. Those are areas that are very prone to corruption, to illicit, and also we have the airports, seaports, and inland depots, which are prone to this. So, to our taxpayers, to our esteemed stakeholders, we urge all of us to be whistleblowers, and you can report matters to do with unethical conduct, conflict of interest, fraud, diversion of goods, or tax evasion. You can report anonymously via iWhistle, and your information will be treated with utmost confidentiality. At the same time, you can write to us through cic@kra.go.ke or our corruption reporting at kra.go.ke. You can walk in person to Times Tower, 26th floor, or you can go to any KRA office for assistance to report matters of corruption. At the same time, you can write to our Commissioner General through Commissioner General Complaints and Information Center, CAC, or you can telephone us. Our numbers are 0726 984 668 or 0709 017 700/800, as you can see at the screen. Also, we have a toll-free number. Our toll-free number is 0800 721 888, 0800 721 888. And last but not least, we normally reward our informers. So whenever time you give us information that enables us to collect revenue, we're able to give you a reward. So the informer reward is just an incentive to the public to share information that can lead KRA from the tax evaders to recover tax revenue. And when you give us information that leads to recovery of unassessed taxes or duties, we're able to give you 5% of what we've been able to collect to a maximum of 5 million, whichever is less. So we want to urge all of us to be whistleblowers and to give us information. So based on what I've mentioned, the initiatives that KERA has put in place to curb corruption, we've been able to reduce our corruption perception index from 52.00, and in 2014 we were ranked to be at 52.7 as among the most corrupt institutions. But because of automation, because of what we've done to ensure that we promote integrity in KRA, we've been able to reduce the corruption perception index to 31.12%. Yeah, this is because of those initiatives that KRA has been able to put in place. So thank you very much. Let's choose integrity. That's my conclusion. I choose integrity. Please also choose integrity. And integrity is adherence to moral and ethical principles that are accepted as good in a given community or organization. Thank you very much. Santi, back to you.
Yes, I can hear you. My suggestion is we can maybe just respond to the ones that I have missed. I've tried as much as possible to respond to them. Members can drop any further comment if my response is not clear. Then maybe we can go through those specific ones. Okay. There's a question here from Kevin Mwati. I think it was also mentioned before on if pension scheme contributions are for the employer only. Kevin, I will want to understand what kind of arrangement is that. Is it an occupational scheme or is it a gratuity? I would want to understand what kind of arrangement so that we know how to respond. In my understanding, currently, if a scheme is occupational, most of them are of the nature that both the employer and the employee are contributing. And if the employee has not met the threshold on what is exempt, let's say out of the relief of 20,000, if as a member you have not utilized your entire 20,000, and the employer has also a contribution topping up on your monthly contribution, then that portion of the relief will revert to the employer. So if you're not utilizing your full relief of 20,000, let's say you're utilizing only 10,000, then the balance of that will the employer will be able to utilize that relief. So maybe just shoot also in terms of me to understand if the scheme is occupational in nature, so that I can give a further comment on that. There's a question from Pauline. On a case where a scheme applied for registration and got an exemption, that one I was able to respond. There's a question from Asman on income drawdown and annuities. I've taken note of that. George, you're asking about there's someone who's asking if the NSSF or if the contributions are in excess of 20,000. So the relief is only 20,000. So any amount in excess of 20,000 will be treated as non-tax exempt, meaning you'll be taxed at source as part of pay as you earn. While at the point of exit, that amount will not be taxed. So if you're contributing 30,000, as I'd mentioned, the 20,000 will go to the exempt portion. The excess, which is 10,000, will go to non-tax exempt. And the 10,000, which is now in excess, since it was already taxed at source at the point of contribution, when you'll be exiting, the entire contribution to underage or non-tax exempt will not suffer double taxation. Maybe, is there any question I've missed? Apart from this one on income drawdown. Thank you, Kevin. I've seen your clarification. The scheme is run by ICA. I think they're the administrators or the approved issuer. The employer does contribution at 20% of gross salary. So if you as a member, you do not contribute anything, then it means your entire relief on you as a member will be taken over by the employer. That is a very interesting employer, Kevin. Are exemptions still being issued? How long does it take? Any pertinent requirements? So on pension schemes, yes, exemptions are still being issued. So it depends on you as the occupational scheme supplying the documents, the requisite documents on iTax. As I'd mentioned, you'll need to go to iTax under the registration tab on the tax relief scheme, apply, and then attach your trust deed and rules. Also attach the checklist on the type of scheme so that we know under which paragraph the exemption is being issued. And then also attach the RBA registration certificate. Once you provide us with all the requisite documents, we'll be able to get back to you, go through them, and get back to you on how soon. The process should take less than a month. Caro, I'll take this back to you. I think I have tried to respond to all the questions. And just to mention that the exemption team is on 19th floor, Times Tower. So you can pay us a visit if you have provided your documentation on iTax and you feel it has taken longer than usual. Then you can visit the team so that you're able to get assistance. Thank you. Back to you. Thank you, Milen. Thank you for your question. So one, I am assuming that that then you have been doing the right thing in terms of because the assumption is by the time you start your investments, you should already be having an exemption. In the absence of that, it means one, that you will be charged withholding tax on the investment income, and then also essentially it means as an employer you do not have a right to give the relief to your members. There has been a case particularly for employers that pay gratuity and were converting their gratuities to pension, and they did not have exemptions. So there will be a challenge because KRA will assume that you had not registered, particularly you had not registered for exemption, so therefore you do not qualify for the exemption. But the best advice is now go ahead and apply for registration as soon as you can, and then also come to our office so that we're able to advise you on how to proceed in terms of treatment, such so that you do not have to incur any liabilities going back. Milen, I hope that answers your question.